Hey, good afternoon, everyone. Good afternoon.
Good evening, Professor Hahn.
Good
Good
afternoon.
evening. How are you, Ibani?
Good, and yourself?
I'm good. I'm good. I'm
That's
good.
good. Happy Monday.
Yeah, happy Monday to you too.
Thank you.
How are you, everyone else? Awa and Devin,
Hi,
Elizabeth.
Professor.
Hey, good evening. All right. So I was going through some tax documents and I didn't know the time was already past 6 o'clock. And God. So we have. Okay, I see 15 people here in the collaborate session, and I'll quickly check the forum. How many are there in the forum? We have at least 16 in the forum, so hopefully, the rest of one more person will catch up quickly. So I also sent out uh, today an announcement about when we return to in-person mode. So we're going to return to in-person mode uh, starting next Monday. Okay. Uh, so, you must have got that by email, so everyone should be aware. Now, so today, right? So picking up from where we left off, right? We're picking up from where we left off. Um, um, so we know that uh, since a couple of, I believe, since two, like since last week, we've been going over ratio variables, right? Ratio. Uh, and we've done a lot already, and there are five categories in ratio variables, right? What's going on? Five categories, right? The first one is profitability category. I don't want to go over everything all over again, so I'll just mention the categories, right? Uh, Profitability category. So there is, basically ROA, ROE, ROK, ROS, right? And then liquidity category. Current ratio and quick ratio, and asset management category. Um, Inventory turnover ratio, and then fixed assets turnover ratio. And also they usually put, what's happening? What's going on? They usually include um, average collection period, but because it's accounts receivable, of course, it's collection period of um, how many days it takes to on average to collect the accounts receivable. So it falls into asset management category because accounts receivable is part of the current assets. But I personally think asset average collection period, right? But it's more like I personally uh, believe that this can be also part of the liquidity, because it's not only about the uh, accounts receivable. I mean, it's not only about the current assets, but it's got the lower this number, the higher will be your liquidity, right? So it's kind of in between, I would say. And then we were talking about this fourth category last time, which is the debt management, right? But I explained everything, right? Debt management category, and there are basically uh, debt ratio first, before debt ratio, times interest earned ratio, times interest earned, which is also called coverage ratio, also called debt services ratio, debt services, because it's about interest, right? Interest is basically debt services ratio. And interesting thing is, it's not debt service, but debt services. They use always, it's plural, debt services ratio. And then there is debt ratio, right? Debt ratio is basically total debt. Okay, I'll just put the word there. Debt ratio, right? Or total debt to total assets ratio, right? Total debt to total assets. So it's basically it's also called leverage ratio, leverage. And I told you leverage means a use of debt. Using debt is called leverage. The leverage is a term that is used very often because we often frequently use it as a metaphor, right? We use it as a metaphor. You leverage something. You leverage this to basically um, um, to gain advantage. I mean, what does that mean? Uh, you are they generally use that expression to mean you are using something to gain advantage. But then, if you think about it, it literally comes from the term uh, lever. Lever is what? We all know an ancient Greek mathematician named what was it just the name just escapes me. It's like it's not Aristotle. It's names like Archimedes, right? Ancient Greek uh, philosopher, mathematician. In those days, mathematicians were philosophers. Archimedes, right? And he's famous for saying, Archimedes, right? Give me a lever and fulcrum, right? Give me a lever long enough, and a fulcrum, then I will lift the earth. Yeah, literally, when you use a lever, right, you get a boost. You get extra boost, right? When you use a lever and fulcrum, you get extra boost. Some people pronounce it liver. I prefer lever because liver sounds like, liver, spleen, the organ, Uh, and we call it leverage, not leverage, right? So leverage, right? Lever. Archimedes said, so um, if you have fulcrum and a lever, you can lift, you get, extra boost, right? So that's, and then why using debt is called leverage? I mean, what kind of boost do we get? Yeah, actually, by using debt, you get a leverage in uh, you get a leverage in uh, return, and in other words, profit, earnings per share. I mean, if profit goes up, yeah, earnings per share goes up. That goes without saying. They are, profit divided by number of shares is earnings per share. So obviously, that goes without saying, right? And then also that will, then it will lead to improved return on equity. Everything will go up. So, in other words, using debt will give you all this. So that's why I said at the beginning, when we were talking about capital structure, right? Once again, this will give you the capital structure, right? Ah, capital structure, right? And I've been telling you, uh, it's not a good thing to have 100% equity. I mean, capital. I've been telling you that the optimal capital structure is found somewhere between uh, like 70% equity, 30% debt, between 70 to 60% equity, 30 to 40% debt, right? I've been telling you this all along. So in other words, that means, think about it, 100% equity, 0% debt, it means this is no good. This is no good, right? Also, obviously, 0% equity, 100% debt. This is, unthinkable because there is no company that has 0% equity and 100% debt. I mean, then you have there's no owner, right? There's no owner. There's only, lender. I mean, a lender doesn't run the company. A lender doesn't. Lenders don't. Um, lenders can probably, lenders are not the lender. Just lenders don't run the company. Lenders just lend money and reap the benefit from lending, which is interest, right? Um, Again, so this is extreme, but something like, let's say, then does that mean 10% equity? I mean, if leverage is good, then something like this, is this good? Of course not. This is clearly uh, that kind of company, that kind of business is uh, unviable. It's not viable, right? It's unviable. So the point is, leverage means use of debt, and by using that, uh, you really get the leverage. You really get the leverage from using debt, right? Which is which will be uh, reflected in improved higher profit, higher earnings per share, so higher ROE, right? And but you cannot increase the leverage, uh, indefinitely. You cannot increase leverage. The maximum leverage will be somewhere between 30 to 40%. I mean, beyond 40%, that's already very, there's a lot of financial distress, right? There will be a lot of financial distress. Uh, okay. And then we talked about, debt to equity ratio. Why isn't it opening? Okay. Debt to equity ratio, right? And the debt to equity ratio is only using, this is the ratio between only, long-term debt only, right? Long-term capital only. So long-term debt. In other words, none of the nothing in the current liabilities is included, can be included in the debt to equity ratio, right? So it's basically long-term debt over equity. Okay. Now that brings us finally to the fifth category, and the fifth category is the valuation ratios. It's called valuation ratio, valuation category. Valuation category. But what valuation of what? That actually means stock valuation. But this is a rule of thumb. It's just valuation means pricing, but this is not about pricing. Not about pricing, right? Not about but a way of a rule of thumb to gauge whether the stock is overvalued or undervalued, right? So for valuation ratios, we have price earnings ratio, and then market price to book value ratio. Market price to book value ratio. Now, if you're taking Finance 300 right, or have already taken Finance 300, but it's unnatural to, I mean, it's easier to take 230 and then 300. If you have already taken 300, and doing 230 will be very easy. But if you're doing if you're doing two courses at the same time, 300 is, a lot more difficult than, 230. Um, but if you um, if you have followed the track, right, suggested, like curriculum map, uh, then normally you would take FMB 100 in the second semester, right? And then FMB 230 in the third semester and FMB 300 in the fourth semester in that order. I mean, you cannot just jump into FMB 100 in the first semester. I mean, if you have met already the prerequisites, then fine. But those who haven't met the prerequisite, cannot just jump into FMB 100. And since FMB 100 is the prerequisite to 230 and 300, if you follow it, in that order, it will be easier. Uh, but most of the students just, save the hardest things, hardest subjects to the last, and in the last semester they all rush into finish 230 and 300 together simultaneously, and it's not going to be easy. Juggling between these two courses it's not going to be easy. Now, so and 230 is not necessarily prerequisite to 300. Just deliberately made it that way because if this is a prerequisite to 300, then it's going to take more time. You have to. So anyway, the point is, when we say, okay, I have it. When we say price, that means market price. It means market price. Okay, and market price, there's a difference between, and even in Finance 100, I emphasize this a lot. There's a difference between market price and book price, book value. Okay, that's why we have, market price isn't exactly the same thing as book value per share. You know what book value per share is? Okay, and it's not necessarily the same thing as intrinsic value. Intrinsic value is usually, represented by V. The symbol for intrinsic value is V. Okay. Now, and the reason is market price is simply, the result of the transactions in the market, the result of the trading. It's the result of the trading, right? It's the result of the trading. And every day, so the market price fluctuates a lot. It fluctuates like crazy every day. Why? Because it's, not based on any fundamentals. I mean, market price is usually, the result of the influenced. It's influenced by the noise. And what is noise? All useless, groundless, rumors, right? Someone said this, someone, oh, I heard it from someone, who knows someone, who knows someone, who knows someone, right? That kind of rumor, right? So it's totally, groundless. It's, a typical example of, someone who says, I know a guy who knows a guy who can get you a great deal, right? A typical example is like, I know this guy. Who knows this guy? Who knows this guy? Who knows this guy who can get you a great deal? And do you know who said that? Huh? That's Donald Trump. It's Donald Trump world, you know? I heard it from some guy who knows some guy who knows, some guy who knows some guy who can get you a great deal. What is this? This is used car salesman mentality. Used car salesman mentality. Isn't it right? It's really just, nothing but, a used car salesman, if you're getting, oh, if you're buying a used car, usually, you get what? You get ripped off. Why? Because, they take you for a ride. You can never, um, they always sweet talk, and cajole and coax, right? They okay, the expression, all that c words, cajole, coax, and coerce, right? Nobody can, do better, in a used car salesman, a wheeler dealer, right? Or what is the a wheeler dealer, or impresario. You know what impresario is? Donald Trump is a typical wheeler dealer impresario, right? A showman, and selling tickets, by buffooning, a lot of but every day the market price is influenced by that kind of noise. So it cannot reflect the true value. It fails to reflect the true value. And the reason the market price is irrational, market is irrational in the short run. And because the market is irrational, and the reason market is irrational is a lot of market participants are average Joe and average Jane. Average Joe and Jane who have no formal training in economics or finance. They just play stocks. They just play stocks, and because they are playing stocks. They play it by ear. They heard someone saying something like, I heard this from this guy. Who knows this guy? Who knows that guy? Who knows that guy? Who knows another guy? Who knows another? And who knows another guy? And who knows another guy who said this is a good stock, right? This is, exactly the mentality of, wheeler dealer, um, impresario, uh, those people who live in Donald Trump's world. And because of these average Joes, average Janes are not rational in the short run, the price fluctuates every day. Whenever they hear some rumors, news, which are nothing but noise. But then there's a reason why they are swayed by noise, because book value is a solid book value is a solid it's based on the solid data. Where does the solid data come from? The solid data comes from financial statements. They all come from financial statements. In other words, fundamentals. They all come from fundamentals. fundamentals. In other words, what's a fundamental? I mean, fundamentals are financial statements, in other words, the data from financial statements. But then, statement. But then think about it. We all know financial statements are on a quarterly cycle, right? I've been telling you over and over. Financial statements are on a quarterly cycle, meaning, they update. And this is not a requirement for releasing financial information on quarterly basis, is not even a requirement for non-publicly traded companies, right? In other words, privately held companies, the companies that are not traded in the stock market, they don't even have an obligation to release the data on quarterly basis. They can use the data for their own purposes, but they don't have any obligation to release it to the public, right? But publicly traded companies, in other words, the companies that are traded in the stock market, they have obligation to release the data quarterly. And then think about it. Quarterly release of the data is called 10Q report, because they file this data with SEC. Okay, then it becomes public information. I mean, everyone can look it up from SEC. But at the end of each quarter, they are going to release the data at the end of each quarter. But think about it. They cannot. That means only after the end of the first quarter data will be available. And after the fourth quarter, only after the fourth quarter is over, fourth quarter data will be available. Because you cannot instantaneously release the data after the end of the quarter. But first of all, think about it. Fourth quarter must end, and then you compile the data, and then you release it. So I've been telling you, the first month of every quarter is called earnings season. Okay? Earnings season. Earnings season. What's the earnings season? It's the first month of every quarter. First month of the quarter. Because, earnings report, in other words, what was their profit? Usually what they report is not net profit, but, they report EBIT, right? So it's not even, net profit. They generally report EBIT. So only after fourth quarter is over, then the fourth quarter data can come out. And then, so when fourth quarter data comes out, the market will realize, okay, we know if we divide this by number of shares, this is going to be earnings per share. And earnings per share is basically the profit per share. So the stock price, we all know, will be adjusted. In other words, you remember book value per share at time 0 plus earnings per share at time 1 is the book value per share at time 1, right? So this is, nobody can dispute this. Suppose the stock, this company's stock was the book value at the end of the last quarter, which became available only this quarter, right? The first month of this quarter. Let's say this was $60. And then earnings per share in the first quarter was $10. Then it will be obvious that book value per share at the end of the first quarter will have to be $70. But think about it. Even this information, right? Even this information is past information, right? Isn't that right? Why? Because when you receive this information, that means what? You are in the first quarter already. You're in the like first month of the first quarter, like January or February of, right? Usually, within January they release the data, but suppose so. And when we make adjustment, so let's say we got this information, earnings per share of the first quarter. That means we are in the second quarter. We're in the second quarter. So in April, we got this information. So then in April, the price will be book value will be adjusted, right? In April. But then this price is price as of what? This is the book value as of the first quarter, as of the end of the first quarter, right? This book value is supposed to be, right? Reflecting this book value is at the end, telling you at the end of the first quarter, the price is, book value is $70. Now think about it. You are already into, so if you got this information in April, right, which is the first month of, but this is the price as of the end of March. So that's already passed, right? It's already 1 month past. Although this is based on the solid data, right? It's past. So think about it. When you got this this book value per share of $60, that was, that means, actually this must reflect fourth quarter price. This is, in other words, December. This reflects December, previous year, December price. But you got this information only in January. And then into, it's already passed, and then you're in February and March. Think about it. When you're in February and March, this information, the price has already moved on from the $60. I mean, because this information is based on the data as of December of, last year. So during this, throughout, January, February, March, I mean, in January, market price will pretty much, come close to, if the market price was like $70 or 75, then they will realize, this stock is overpriced, overvalued. So there will be a downward adjustment called correction. Downward adjustment called correction. In other words, people will sell because the true value of this stock is $60, not 75. So it's, a lot of, there's a lot of hot air. So sooner or later, before the price falls, they sell. And as they sell massively, the price will fall. It's like a self-fulfilling prophecy. The price will fall. It falls until when? It falls until the price is settled as 60. Price reaches $60. And is it going to fall anymore? No, it's not going to fall anymore, because even if it falls, it will quickly come back up, because it won't deviate too much from the true value. It won't deviate too much from true value. So in other words, once it reaches $60, there's no incentive for anyone to sell, right? I mean, the reason they sell is to realize the capital gains. I mean, if they sell it at $75, they are making $15 gain, right? Because eventually the price will adjust to this. And if they sell it before it reaches $60, then they make $75. I mean, as long as you can make even $1 by selling it, you will sell. So if the price is 61, you will sell, and you make $1. I don't know if it is worth selling it if it is 61, but still, it's rational as long as you can make $1, right? As long as there's a positive gain that can still be made, you'll sell, right? Again, so right after this information is released, so in January, the price will for a very brief period, the price will adjust. There will be a correction. The price will be close to the market price will be close to the book value, right? Again, I have been using P as the symbol for market price, and B for book value per share, right? But then as time goes on, so we're moving away from January as we go into February and March. Then think about it. We don't have any solid data anymore. I mean, when the book value was $60, that was in early January. But as we don't get the data release of data until April, right? We don't get any solid data until April. So during February and March, and January, they make all these, speculations, In other words, so what would be their earnings by now, in February? No one knows, because they don't release the data until April, right? So then, because of all of those guessworks, speculation and guessworks, because of all those, speculation and guesswork, they will try to find, there will be a lot of fluctuation in the market price, right? So then, think about it. Then that's why that took us a lot. That's why we need valuation. In other words, uh, that's why we need, right? Uh, Pricing models, right? And the pricing models in FNB 100, you did, bond and stock valuation in FNB 100, right? You learned how to value bond and stock pricing. And they are basically, based on the, uh, they are called, discounted cash flow model. Discounted cash flow model. Think about it. The rational value, rational price, the rational price or intrinsic value the rational rational price, intrinsic value, and fair value they all mean the same thing. And rational price, intrinsic value, fair value all depend on expected future cash flow, right? They depend on uh, they depend on expected future cash flow. And this future cash flow is, of course, free cash flow. And of course, if you have expected future cash flow, discounted cash flow model is basically doing what? Sum of, right? You're discounting, right? Uh, Sum of all the, discounted future cash flows. That's basically intrinsic value, right? That's basically what intrinsic value is. Okay, and that's what we do with the discounted cash flow model, right? This is how we find and think about it rationally. Uh, uh, all the financial assets, their value depends on their expected future cash flow, right? And for bond, it is quite obvious because bond there is no uncertainty about bonds future cash flow. Uh, but for stock, this would be a little more tricky. Then it's a little tricky. Uh, uh, but then uh, at least the point is um, that's what you learned in Finance 100. Uh, Also in Finance 300, you will learn it in more depth with more depth. Um, But the idea is, this is how you, this is a rational price, because rationally, what else is there? Rationally, what else? What other cash flows can you, what other, should be the factor in determining the price of the stock, right? Other than the future cash flows, everything else is noise. Everything else is noise, right? Um, so we understand, basically valuation models are a separate issue. I mean, when we say uh, stock valuation ratios, stock valuation ratios, they are not really about pricing the finding the rational price. They are not really about pricing, but it's rather a rule of thumb. It's rather a rule of thumb to find whether the stock is overvalued or undervalued. And two most representative ratios are price earnings ratio and market price to book value ratio. And we all understand, I've been telling you, the the price here means market price, okay, and therefore price earnings ratio means price over earnings per share, okay. And important thing here is this: the price at time zero. This should be the price at time zero, and earnings per share is the earnings per share at time one. I mean, that's only natural. I mean, that's what, because today's price at time zero, depends on the expected earnings per share at time one, right? But since earnings per share, the data, I mean, if at time zero we don't have the data for time one, earnings per share at time one will be only available after the first quarter is over, right? Although we can have a forecast, but the actual data will be only available after the first quarter is over. So therefore, in reality, it's pretty much, it's pretty much like this. They use, so it's not really correct price earnings ratio. This is not really, but this is what they use, for practicality, right? It should be this, but because of practical reasons, they use this. That's not and market price to book value ratio, right? Again, so this is obvious. It's market price at time zero over book value per share at time zero. Okay. Now, so what do we take? What do we take away from these two ratios? Now think about it. Price earnings ratio is book value first. Market price to book ratio, it's quite obvious. What is this telling you? It's the this ratio can be either, all these ratios can be either three possible values, right? Three possible ranges. Three possible ranges. What, greater than 1, equal to 1. Okay. I said price, market price to book value ratio first. So market price to book value ratio. Now think about it. If price to book ratio is greater than 1, that means the market price is greater than book value. So market is overvaluing, market has overpriced the stock, right? And if it is less than 1, market has undervalued the stock. And of course, overvaluation means, you'll have to pay more to buy this stock than what it is really worth on the book, right? What it's really worth on the book. So it becomes an expensive stock, or expensive for its true value, right? More money for, you have to pay more money. It's cost, it costs more than it's. But then, if you ask why, market has overpriced it, before the last quarter, before the fourth quarter information, fourth quarter earnings report was available, there was a lot of positive expectations. There was a lot of positive expectations, right? That went into this market price. It pushed up the, right? On the other hand, if this is less than 1, there was a lot of negative expectations that went into the market price, right? So by looking at this, you can tell whether it is overvalued or undervalued. Now, price earnings ratio, then the price earnings ratio, similar rationale, but in price earnings ratio now, let's think about it. If this is price at time 0, if it is really like this, earnings per share at time 1, and also it can have 3 ranges, 3 possible. It could be, greater than 1, less than 1, or equal to 1. This is about earnings per share. So it's forward-looking. At least you can tell, oh, they are forward-looking. Isn't that right? You can tell that they are forward-looking. Because it's 1 quarter ahead. It's future. Of course, that data can only be available after this quarter is over. But even if you use, so then, what do we normally use? Actually, I said previously that what it tends to be most of the times is going to be like this. But usually what they do is they use, and then average earnings per share, like, for the last 4 quarters, right? So that's what is, what's really going on. I should say, because this is a question mark, you don't know. Then think about it. This tells you basically, whether the stock is very pricey or not, right? Whether it is pricey or not. For example, if earnings price ratio is, the lower the earnings price ratio, think about it. If price earnings ratio is something like 5, let's say 5, what does that mean? If this number is this number is 5, what does that mean? If this number is 5, it's something like this. You paid $100 and it gave you $20 earnings per share. And it's going to be 5, right? And then also you bought a $20 stock. It gave you $4 earnings per share. It's also 5. So as far as the earnings power is concerned, these two stocks are the same, right? And then the lower the number, the lower this number, that means the more earnings power for the price. On the other hand, suppose this number is you paid $100 for the stock, and it gave you $1 earning. What's the ratio? The ratio will be 100. Now, what does that mean? If I were to spend my $100, I would spend my $100 to this stock rather than on this stock, on the other stock, right? Because this stock is too expensive for its earnings power, and for its earnings power, right, the price is overblown, right? And for its price, on the other end, you can also say, for its price, it's got such a mediocre earnings power, right? So a high price earnings ratio means, too expensive for its earnings power, right? Also, suppose that same thing, you bought a stock, you paid $20 for the stock. What's going on? $20 for the stock, but it gave you 20 cents. Oh, that's still dollar. It just gave you 20 cents. The ratio is 100. So as far as the earnings power is concerned, both are same stock. They are the same, right? So you can quickly jump into the conclusion, oh, the lower the price earnings ratio, the better it is. Yes, you can say that. But again, there are two camps in finance, right? One camp is basically, the proponent of the low price earnings ratio. The other camp is the proponent of the high price earnings ratio. They are saying there's a reason why the high price earnings ratio is maintained. This, we don't have time. We ran out of time, so this we will, continue in the next class. Okay. So, any questions so far? Any questions? Any questions? All right. If you have no further questions, Awa, you have any question? Awa?
No, thank you, Professor. No.
All righty. So, if you don't have any further questions, I'm going to call it a day, or call it a night, rather. And have a great evening. And I will see you guys next, this Wednesday. Okay?
Thank you, Professor.
All right. Take care, everyone.
All right. Good evening, Professor.
All right. Good evening.
Bye,
Good
Professor.
evening. All right. Someone had a question? I don't think. Okay. All righty. Stop.